Yeah, hi, Simon Gardner-Bond. I'm at TechMet. We're a private company investing in critical minerals projects for the energy transition, from mining, processing, refining through to recycling. We've got a portfolio of 9 operating assets now.
Yep. Hi, everybody. My name is Barry Jackson from AngloAmerican. I've been working with Anglo for 12 years now in their marketing division. Before that, I had 10 years with Outokumpu, mainly in Finland, in the stainless steel business. My role at AngloAmerican is to originate third-party sources of product, particularly copper. So we look to do investments for offtake, which we can then channel through our existing sales, logistics, marketing network.
Good afternoon, everyone. Liam Farley, Xcelsior Capital. We're a mine finance arm of a commodity trader called Wogan Resources. We essentially finance, using our capital, the long-term offtake and trading rights associated with critical metals, particularly focused on off-exchange metals and minerals, where Wogan have a long-standing 50-year heritage in trading those. And that's us.
Thank you. Dahdah from Natixis. We're a French investment bank, heavily focused on metals and mining. Myself, I'm an analyst and with 15 years of experience, and cover the metals and mining sector with specific focus on the energy transition.
And so I thought we could kick it off kind of looking at this, looming supply crunch that is meant to be happening in the metal space. So where do you see some of the biggest deficits in supply in the coming years? And maybe looking forward, any kind of solutions, or, how can we kind of bring the focus back to spur more exploration to kind of get to these metals? I'll pass it over to Bernard to kick it off.
So from my side, from what I've looked at in terms of metals, the most obvious one that everyone is talking about is copper. So when it comes to copper, we're looking at a deficit of like 600,000 tons by 2030. Cobre Panama, obviously, disclosure doesn't help. The lag times are huge. So we try to look at how much capex would be needed to achieve the energy transition. So if we're going to go with an energy transition to net zero economies by 2050, our calculations and estimations would probably need $29 billion to $30 billion worth of investment in copper mining every year between now and 2050 or 2045, which is huge. Just to put things into perspective, last year, I think we were talking about capex of around 15 billion. But it's not unheard of, because back in 2012, it was a level that we had seen. But the big question is, what would it take for those levels to go back so that we have enough of capex and and we try and avoid this massive deficit. And what we find actually is, over the past few years, we've seen a massive amount of dividends being paid out. So if you look at the sample we looked at of copper producers, last year they were probably paying around $10 billion worth of dividends. Historically, over the past, I would say, six years or so, they were paying $4 to $3 billion worth of dividends. So point is, there is a point where probably shareholders have to take a longer-term view and accept lower dividends to be able to free up some money for some capex. Given the long lead times in metals and mining, I'd suspect even if you coughed up the $28 billion or $30 billion today, that wouldn't be enough. I mean, it's not just about money, it's about taking the initiative now, because there is a lag of 5 years for expansion capex and way longer for a new project.
I suppose thinking about the battery metal complex, the the prices today, from our perspective, are as a result of its own success in recent years in terms of the growth in the energy transition, EV demands, the investment into the manufacturing side. We've all seen that growth and commitments and in capex on the cell manufacturing, etc., and the increasing processing, particularly in China, to deliver that demand. I think as a result of that, we had a big push in exploration. I think 90% increase in lithium exploration last year alone. Lots of money spent bringing new products to the market, particularly on the hard rock side, out of places like Australia. And so, what's happened is the supply has just caught up and overtaken current demand. And I think that invariably that's going to mean a pullback in available capital, a pullback in capex spending on some of the minerals and metals. We've seen that in Liontown, for instance, in Australia, and a pullback on the available capital to expand in phase 2. And I think that sets us up for the next, if you like, smaller cycle in these metals and minerals, which invariably will come again. And so I do believe there is this transition, but in that transition there is going to be a lot of volatility. And I think it's about how you think about playing that volatility, or the way in which you capitalize on that volatility is an important part of thinking about the battery metals sector certainly from an investment perspective.
Yeah, from our discussions with customers and downstream parties, then I would say there's a general deficit, if you like, across the products for responsibly produced and sourced, low carbon, traceable products. So customers are very much looking for products where you have clear transparency on the ESG metrics around carbon footprint, around the local employment conditions, and various data points and provenance that they can use to support their own sustainability strategies and their businesses. So what we did at AngloAmerican to solve for this challenge is we developed a blockchain-based traceability solution called Value Tracks, and that gives our customers a dashboard of all the metrics that they require on a product-by-product basis, which then can feed into their own reporting requirements. That's becoming more and more important in the interactions and sales discussions that we have with our customers. It's price is still important, but these other metrics around ESG and local conditions are becoming increasingly relevant and important for those discussions. So I think that's where we see the biggest change in customer demands for the battery metal products, and particularly because it's going into this battery metal OEM automotive company landscape, which has a bigger appetite for those things than traditional steel companies.
Okay, the question is, where do we see most supply gaps? I'm going to expand on Liam's answer. The market's going to get a very rude awakening in lithium. As far as I can work out, nobody really understands how much it costs to build new production. Everyone is very much underestimating how much it takes to get it out of the ground. Operating costs are way higher than people think they are. You don't have to take my word for it. Just go and look at a company results. Anybody developing a lithium project, look at the capex creep, look at the opex creep. Go and ask the CEO of that lithium project when he's priced in his costs. You'll find it's 2 years old. Go and look at the inflation over the last 2 years. The cost for the world to provide the lithium that it's going to need over the next decade is, by the price that it's at and the price that most people are forecasting it, is far underestimating the reality, I think. So that's a good place to be in. I do know tin. We've got tin assets in Rwanda. I didn't get a chance to introduce myself down. We've got some tin mines. I think tins are very interesting. It's a tiny market, really, when you're thinking about copper. But I think your comments are pretty spot on. Most people are making money at 33,000, but also the supply is dropping off, and it looks like it's going to be, I'm not sure how much will come on in the scale that it came on in the last run. So I think to generate investment capital to cause new production to come online is going to require higher prices than we have, or at least these prices that we have now. The other kind of metal that we focus on, which I might highlight, is rare earths. The price is extremely low right now, to the point where hardly anybody is making money. Even a lot of Chinese production, who tends to dominate the market, is losing money at these prices. I'm not going to speculate on the reasons why. There's certain sort of political and economic reasons why the price might be suppressed. But I can tell you that if you can find a rare earth project to bring in new production over the next few years to go into the magnets that the EV industry needs, if you can find a project that makes money at these prices, good luck.
Do you want to talk a little bit more about that kind of price volatility in some of these key metals that we've been seeing recently, and how it's impacting kind of the financeability of projects and demand and all of that?
I think across the metals complex, especially in the critical metals complex, as a group, we focus on off-exchange more than on-exchange. And actually, you're seeing changes in end use of some of these metals that are really stimulating new production. And if you step outside the core battery metal complex, and you look at things like tin, and you look at things like antimony, which is, as of today, nearly 18,000 bid in China on physical, which has gone up from about 12,000 at the beginning of the year. That's related to solar panels and use in solar panels, antimony as an example. So there are still these metals in high demand with pricing that's incentivizing that. I think, as I said before, the battery metals are a victim of their own success in just the money that's been piled into those and the production that's come on. One other thing to note is, to get capital into our sector in general, I think the cost of capital is a lot higher than other sectors. When you go to investors and you say invest in metals and they're not metal specialists, you have to compete with every other sector out there, and so the hurdle rate becomes a lot higher. I think in high interest rate environments with lower commodity prices, the ability to attract that capital is significantly harder. And so the combination of these prices today, high interest rates globally, high cost of capital, it does really is creating a lot of pressure, especially on the junior side of the market. Can't access listed bonds and other type of debt investments, debt markets.
So from my side, what I would say is you've got the issue of some of those emerging new metals, though they're not new, but like lithium or cobalt, in terms of how much we use. And naturally, that's where you're going to get much more volatility than better established, more liquid markets like copper. But whereas with copper, you can comfortably hedge for a long dated. The issue right now, I guess, with lithium and cobalt, it's not as easy and to hedge, to find banks that do it, or and also in terms of how long can you do it, how far can you do it, and that's going to cause a lot of headaches in terms of for your financing your project. If you want to take it, let's say some project finance, sometimes they want to impose that you hedge X amount of your production. So I guess the more liquid the market becomes, the more products in terms of hedging capabilities we get. Probably that might help reduce some of the volatility. And again, to your point, being the victim of its own success, battery metal is. A few years ago, everyone was shouting, "We need more nickel. We need." I think Elon Musk and everyone shouting, "We need more cobalt, etc." Mm-hmm. And all that came in, and all of a sudden it's like, "Whoa, that's too much." But that's typical of mining cycles, where you have got like these steps. Like think of supply as being steps with a lag every 5 years. It just jumps given the time it takes to produce, and then demand is just a straight line that cuts through, and then you end up with oversupply or deficits, especially in those smaller markets.
And I suppose changing technologies or battery chemistries will also impact the demand for various metals as well. Does anyone want to talk about kind of how they see the technological risk impacting the market?
Yeah, I'll say I don't. I think people get too worried about a shift to LFP. I mean, that tends to be if you're looking at the world as one number, and it's not. China's dominated the growth and the adoption of EVs, and the way that they drive and the way the Chinese consumer, what the Chinese consumer wants from a vehicle, is very much suited towards a lower weight, lower power, lower range battery. So if you look on a global scale, no wonder LFP is dominated because it fits to the market that's had a huge government subsidy and push to be able to essentially force people to buy EVs. But you don't need to look very far, in Europe and the US and the other major autos markets to see that there is, that's not going to be the same pattern. There's going to be a much more, desire for bigger cars, fair enough, more expensive vehicles, but the consumers are much more discerning. The consumers in the US and the West, I guess, will want to have a better performing vehicle. And so, there's OEMs in the US that have come out quite recently and stated their intention to be a nickel-rich chemistry for the battery. So I think what you'll find over the next 10 years is the West sort of regaining its market shares, if you want to think about it that way, of batteries installed and sold, such that the nickel-rich batteries will at least maintain the current market share. I don't think they're going to be phased out. So there's definitely going to be a demand for nickel cobalt.
Yeah, I think to cover both of those questions a little bit and to pick up on this perception of risk, I think after big events like COVID and the financial crisis, then people's perceptions of risk is heightened. After the big financial crisis, then all analysts were, giving a much higher weight into another crisis coming because they didn't want to not forecast it like they did with the GFC. And coming back to the financing topic, then if you look back to the end of 2022, I remember seeing this Bloomberg poll where every single analyst forecasted 100% probability of a recession in the US in 2023. The reality is we saw is quite good growth and still quite good growth in the US. So that environment of expecting recession is not good then for investment in the junior mining section. And we've seen that challenged over the last couple of years because of those economic perceptions. On top of that, I think we've had then a heightened political and social risk in countries. So when you're looking at projects, you look at the grade and the resource, you look at the political and social risk in those countries as well. And social media has been great for many things, but it's also meant it's been easier to publish misinformation. It's been easier to galvanize support for protests and so forth. So we're seeing in certain countries where it's becoming much more difficult, longer lead times, more costly to develop projects, which do have these really good resource bases. And my view on the nickel battery as well, I've been in the nickel industry 20 years, so I like nickel. But my own personal preference is when I was buying a Tesla, then I could have bought an LFP-based Tesla, or I could have. What I did was buy a 80% nickel battery at Tesla, and doing the numbers, then the nickel-based Tesla was 18% more expensive than the LFP-based Tesla. But for that, I got 18% more range, which means I could travel further without having to recharge. And I got 27% better performance measured by the 0 to 60. So for me, that was the solution that I wanted, a fast car, a car that drives well and gives good range between charges. And there are plenty of other people that are not particularly want to buy the cheapest car in the market. They want a car with good performance and it suits their preferences better. So I think there will continue to be strong demand for the nickel-based batteries, particularly in the West. If you're not an EV driver, you're obsessed over charging infrastructure. So if you're obsessed over charging infrastructure, you're going to buy a car with the highest range and it means you don't need to charge it as often and search this infrastructure base for chargers. So I think if you look at the range of cars out there, I think that the performance sector, the Mercedes, BMWs, those owners want to have a good driving car, and it's that kind of sector of the market will continue with high nickel batteries.
A couple of comments from my side would be, everyone's quite worried about a disruptive technology, sodium-ion batteries coming in, right? End of lithium if they're 20% cheaper. Coming from the left field, solid-state batteries, cutting out the anode components, things like that, and influencing it, and even changes within those cathode and anode compositions. So whether it's a nickel heavy or light battery, whether it's a different type of cathode, whether it's a synthetic graphite versus natural flake, and the impacts on the market in those regards. So I think there are permutations to that. One thing I like to think about is these companies investing, tens of billions of dollars in battery manufacturing facilities that are huge at scale and are there to be there for 20, 30 years. It's unlikely that they're suddenly going to deviate to a new technology in a short space of time. This is a 5-10 year cycle. So I think there is longevity in the next 5-10 years with the existing technology, albeit with nuances within that, i.e. how much synthetic versus natural flake graphite in an anode mix, as an example. Who prioritizes that? What's the ESG components? All the rest of it that link to graphite pricing. And I think that's two things. I think there are technologies out there that could be just quite disruptive. I think they have a long way to go to be proven at scale and replace the existing. So I totally agree on the consumer-led point around the West wanting premium BMWs and Audis and all the rest of it and long range. My other point would just be about what is the hindrance on everyone adopting an EV? Why isn't everyone in this room buying an EV tomorrow? And I think there's two things. It's affordability, and it's about charging. It's about decreasing that range risk and making sure you can charge up in 15 minutes and not have to, fight over a Tesla supercharger on half-term holiday as you're driving up to Scotland. I think that's two things. I think that as the charging infrastructure comes through, maybe that is the disruptor in terms of moving to lower range cars because you feel more comfortable driving around with less in the tank, so to speak. And I think that could be one of the things there. So I think it's very nuanced, but in the end, I would support a long-term, 5-10 year view that the current chemistries are going to be prevalent.
From my side, I would say it's interesting to look at some of the. If you look at the LFP and MC battery story, you go back to 2020 and you look at some of the major data providers or consultancy firms in metals and mining. And their expectations for 2023 was that NMC would be 70% of the market share for 2023, and LFP would be 14%. And for 2030, 50% of the world's would be NMC, and something like 19% would be LFP. What's happened within 3 years actually is every year they publish their little chart. As for 2023, we have 44% LFP, and we've got something like 35% or 30% NMC. And for 2030 now, their forecasts they've revised it as being something like 44% LFP and for NMC just under. So within 3 years things can change, and I think the LFP performance has improved quite a bit more rapidly than I think the market has expected. But again, I think to your point it would be almost impossible for lithium-ion batteries to be completely replaced within 3 years. Again, those are long cycles, long investments that takes place. So you can do some improvements which you see quickly, like in terms of the battery ranges. And actually, if you look at, not to add to any advertisements or Tesla or whatever, but Xiaomi, if I pronounce it properly, have released their new car in April, and they say, they've got three versions of it. The first two versions, their cheaper ones, are LFP. The higher end one is NMC. But their LFP one still does, apparently, on paper at least, from what I read, 800 kilometers, which is huge on a charge. And their NMC one would do close to 800, except it's a all-wheel drive system. So things can change rapidly, but for the chemistry itself, I think you're talking about long-term investments. It'd be hard to see putting, even if in lab conditions, they're able to reproduce it, to produce some things in real life conditions. It remains to be seen from the commercial side of things. It would take 10 years at least to put in.
Yeah, I think great points. I think it's billions need to be invested in the R&D for some of these new materials that a lot of people will come on stream very quickly and take over. I think coming back to my experience with the Tesla, then what are we trying to solve for? I don't need a faster car. I don't need a longer range. We can say we would like a cheaper car. So I think that we can solve for that, but raw material prices and the improvements in the production and economies of scale in EVs will solve for that to some extent as well. And then you do have these billions in uncertain technologies. When I first started to go into the battery conferences in 2016, 2017, then the consensus was solid state would be commercialized in 2025. And there were some other fancy chemistries that were going to be commercialized imminently and taken over, and we're still a long way away from solid state commercially and these other chemistries that were touted. So I think you've got something with NMC, with NCA, with LFP, which is proven years already in the performance environment. So if you're a battery manufacturer, a challenge if you would want to invest in trying to reinvent the wheel.
So before we kind of change topics a little bit, do we have any questions from the audience looking at kind of this commodity folk? Okay, we've got a few. Here first.
Thank you, guys. A bit more, can other people give their view on rare earths? And I'm not quite sure if I understood Simon's point in the sense that were you suggesting it's kind of rare earths outlook is similar to lithium in terms of sort of chronic oversupply and costs that are higher than people expecting? I just didn't quite understand your...
I'm just saying that the price is too low to justify any new production, and it's a very opaque industry because it's so tightly controlled or heavily controlled by the Chinese. So it means that for any analyst, it's very difficult to get a good view of the global market. But from what I hear, even a pretty decent chunk of Chinese production is losing money at these prices, or should be losing money at these prices. How they sell their product, I don't know. There's maybe they're still surviving and putting material in, giving material to their customers because they have a good sales agreement that is not actually linked to the price on the screen. But if you look at even a good new project, a good rare earth project out there, it's not going to make money at $50,000-$60,000.
Just a comment from my side on that. So we've been spending quite a time looking at rare earths from a trading perspective recently, and looking at the upstream opportunities in the sector and trying to understand how to deploy capital effectively into that space. The challenges right now is that 60% of the world's rare earths are produced by China, 40% external, but 90+% of everything is processed in China, and no real permanent magnets of quality are made outside of China. So they absolutely dominate the technology downstream side of rare earths. As a result of that, they completely choose how they consume rare earths in a way that suits them in a broader context than just upstream. I think rare earths is probably paying a bit of a price of that dynamic. That the West is spending a lot of thought and time, and to an extent some money, trying to rebalance that equation. But in truth, they're 20, 30 years behind. They might catch up faster than that, but it's going to take significant, very low cost subsidized capital and political will to do so. And I think that the other part of that is on these critical metals is, to someone's point, there's no LME sort of spot market and tradability of it. It's very opaque. And if you look at the actual processing downstream complexity of some of these metals and minerals, it's really understanding that today, if you're a rare earth concentrate producer and you're producing 55% concentrate, there really is only one place you can sell it, and it's China. So while everyone wants to pivot to the West and value chains, that's not really an option for producers today, and the pricing isn't really there anyway. So it becomes quite a hard opportunity. So what the West really wants is semi-processed intermediate products, so MREC and mixed rare earth carbonate, metal oxides, and that gives you more flexibility about where you process it and some opportunities. But ironically, if you were to process concentrate into a mixed rare earth carbonate and then look to make oxide and then a magnet, it's all going to go back to China anyway because they control the magnets. So it's a great example of, I think, maybe it feeds into some of the questions later about security of supply, value chains, manufacturing, onshoring, these types of conversations. But it's one of those commodities where you really have to understand the full value chain to actually make an assessment of upstream investments. And I think that's a really important thing we look at. It's why we are a trading firm as much as an investment house, because we feel that that's a way to really understand some of these markets and the pushes and pulls.
We had another?
My question actually follows on exactly from this topic about downstream. So China dominates, processing. So my question to the panel is, do you see, because there's been a lot of noise about industrial strategy from governments, industrial policy from governments. So do you see governments and also private sector actually putting in the investments to diversify processing outside of China?
Yeah, so if I may answer, I'm going to talk to you from a European perspective of how I view things. Is they recently released something called the Critical Raw Materials Act, and in that Critical Raw Materials Act and the Net Zero NZEA, it's another act, Net Zero Emission Act, also targets of how much refining has to be made in Europe. And I think they would like to have something like 60% between now and 2030 of whatever they consume in terms of critical metals and minerals refined in Europe. Can it be achieved, between now and 2030? Probably not. The time is too short. So they've put a whole set of legislation in place to accelerate the investments. So what I've seen in France particularly is the French government is probably and I'm not French, I work for a French bank, so I'm not going to make an answer for the French government, but they've put in place a critical minerals fund, in which they put in 500 million, and then another fund called Infravia raises 1.5 billion. So they've got a 2 billion euro fund, and the idea is that they go around shopping for some of the assets, but also developing some of the refining capabilities either in Europe or in friendly nations. So 2 billion is still, it's not nothing, but it's not enough. And I know that I think Italy and Germany are thinking about reproducing a similar type of fund. But again, back to your question, that's all taking a lot of time. It's all very slow. And I think one of the big issues also we're going to have, to your point about 20 years ahead, is the technological know-how, the skill set. How much of the skill set do we still have in Europe? We've lost a lot of it. A lot of it's become outdated. A lot of our engineers end up working in banks. You look at engineers in French banks, and they've got thermodynamic PhDs. They should be working in China. They'd be working in the industry itself. So there are that issues just about the money and the legislation, but also about the skill set, which makes it quite complicated.
I'd like to continue that discussion about kind of the government policies and how they're kind of propelling this industry. So obviously the IRA was one of the kind of early kind of groundbreaking ones, and then Europe as well has followed suit. So how much do you see these impacting kind of financing and growth for the industry?
Again, from a European perspective, I think a lot of you know about probably the Inflation Reduction Act, and that panicked the Europeans basically, because what we saw in Europe was a lot of the investments, second phase investments, let's say for solar panels, just as an example, the projects that were supposed to be made in Europe, actually the investments went to the US. And I think the FT had done an article, I can't remember what the numbers were, but how much money basically the Inflation Reduction Act kind of like sucked from what have been investments in renewable in Europe and send it to the US. So the fight back came through the CRMA and NZEA. And if I take it from a battery perspective, the Americans have been very good with the IRA at encouraging investments. They're very clear. You will get $45 per megawatt hour for every battery you produce. You will get $7,000 for if your car is a free trade agreement, etc. So they were very, very clear. Unfortunately, the Europeans, it was much more wishy-washy. We're not sure about how much money they give. You know, they said they wanted to give 82 million or 92 billion for gigafactories. So I'm talking about the gigafactory example here. Probably 60% would have gone to the gigafactories and the rest for solar panel and wind turbines. But the problem is, I guess, that that's in terms of grants and in terms of financing. So it's the start of the project. So you're not sure how much your project is going to get, if it's going to get or not. Whereas the American one is much more clear. Now, the advantage at the end of the day of comparing both, I guess if you're a well-established gigafactory or battery producer, the American system, the IRA, is much more advantageous. Whereas if you're a startup in gigafactories and battery production, probably the European way of doing things, of giving a grant, is more interesting. And that's probably what we're seeing in terms of how the investments are taking place in both zones.
My question to the panel is, what's your view on the green hydrogens? There are lots of demand coming in the commercial vehicles and lots of demand for the green hydrogens.
Sorry, our outlook on green hydrogen, I don't know if you've got any views you'd like to share on.
I think the green hydrogen was like a lot of these things, had its sort of moment of it's all coming rapidly. And I think that the truth is it's a longer term transition involving a lot more infrastructure and renewable capacity to incentivize green hydrogen. I think I read that to make the European steel industry green, you would have to use 100% of the available renewable power in Europe to power it, which means you've got to replace that to still make our homes green and everything else green. So I think that is about the capacity on renewables. I think as a result, we're seeing in certain metals that maybe feed into that conversation that there just it's not seeing that demand coming through yet. And I think that a lot of that is going to come down to this race to lower cost electrolyzers and scaling technology, scaling manufacturing in a way that the Chinese have done so well in other things that we see consistently, whether it's solar panels, battery cells, and green hydrogen is just another phase. So I don't personally hear a lot about that in the sort of shorter term, mid-term, but I think it's a very interesting area of growth, and that obviously influences some metals more than others. But I think it's probably a 10 to 20 year story, in my opinion.
Okay. So part of a lot of these government initiatives in terms of new policies has also resulted in kind of the regionalization of supply chains. So wanted to talk a little bit about some of the impacts that this kind of regionalization is having on the space, whether positive or negative, and kind of where you think that trend should continue on. Anyone who wants to go first?
You mean in terms of the sort of onshoring and I think it's interesting, isn't it? We want as a consumer a lowest cost commodity, lowest cost goods. The West have been profiting from the offshoring of its manufacturing now for 30 years into China. And we wonder why today we turn around and we suddenly go, oh, there's risk on our supply chain. I mean, we've all been benefiting. The growth of our economies has been based on low cost input feeds from the likes of China mainly, they're made in China. And I think that's something that we've chosen to do as nations now for a generation or two. And reversing that trend is very, very difficult. So I think there is this idea of policy and kind of what we really want in life. And the two things are diverging. And this nearshoring and deglobalization is really an overall trend we're seeing. And I think we're seeing that, this is an election cycle in the US, right? So we are seeing announcements on import tariffs on Chinese EVs. There aren't any EVs imported by China into the US currently, but it's an interesting headline. And yet that's about politics, not about reality. So I think that there is this push, but what I think that is an inflationary push. I think to capture supply chains and value chains internally and nearshore them is a case of saying, well, I want mines in my backyard. I want manufacturing facilities. I want to close that gap. But, I was reading a stat yesterday about the cost of EVs in different countries. The Chevy Bolt in the US, I think is about $28,000 model. The equivalent quality with range, battery type, size car in China is $10,200. So if you onshore, you can't possibly replicate that low-cost structure. So just if you take that factory from China and put it in the US, and if you import low-wage Chinese people, which won't be allowed, the cost goes up. So I think it's an inflationary concept or influence. And I just question whether the consumer in the end is willing to pay for that. And I think it also leads to an idea that is the drive for energy transition, net zero, still the priority? Or is it about security of supply and economics? Because I think the two things are quite divergent in some ways. And since we've had the cost inflations and everything else, we've had a lot less focus on net zero and timeframes starting to slip. And I think that's something that's going to continue. And I think if we want to get to an energy transition net zero in reality across our economy, we have to adopt lowest cost inputs. And those lowest cost inputs are Chinese inputs. And I think anything about nearshoring, I think is very positive potentially in terms of dislocation on pricing. And there's opportunities in the junior mining sector and the mining sector in general to capture some of those dislocations. But I think as a broader concept, nearshoring is essentially an inflationary thing that will drive up prices globally for those consumers.
Anyone else want to dip in on that?
Yeah, I think it is going to be interesting to see how it plays out over the next few years, because I think Liam's right that price is everything at the moment, and because of the recent inflationary environment, it's become the only thing. But at some point, I do feel that the underlying sort of goals from an energy transition will start to come back again. So, and it's not just China, it's distance traveled, it's, water used, it's, energy spent to get to, for your product. So at the moment, yes, there's no premium for these, inputs or these metrics in a product really in the market. But I do think that there's going to be a point when that is going to come back again, when the world's in a slightly better financial position, that people will start to question and say, oh, great, we can all afford our EVs now, but how did they get made? And, how are the people treated around the operations that produced the elements that went into these things? So I think it's cyclical like everything else, and it'll come back. But I do still think nearshoring, onshoring, diversification of supply chain has other elements other than cost.
Do you think consumers are currently kind of considering those ESG, components when making?
No. Nobody buys. Barry aside, nobody buys an EV and even knows what battery they've got in it. So, if you go out now and you go into a dealer and you ask them what battery, they won't know what battery's in it. They definitely won't know where the materials came from that made the battery. So I think we're a way off. But like I said, if a little bit of time goes by and we're in a slightly better position where I think also the choice year on year has been getting wider and wider. So how do you differentiate yourself in the market? It was easy for the first, 2-3 years ago, there were probably maybe 4 or 5 models of EV to choose from, like using the UK as an example. I don't know how many there are now. There must be 50 different models to choose from. So when that becomes even bigger, how do you differentiate yourself? One way to do that is to say, yes, okay, we've got this stamp of ESG compliance and sourcing and everything else. So I think it will definitely have a part to play.
I mean, from the side I look at it from is that pretty soon we're going to be whipped into doing it, into the ESG. You just have to look at CBAM, the Carbon Border Adjustment Mechanism, that's going to be put in place, that's already put in place, so self-declaration of how much your aluminium that you import, what are the emissions of your aluminium on your steel, and eventually it's going to be rolled out for copper and some of the other metals like nickel eventually. And starting 2027, if I'm not mistaken, or 2026, anyone importing into Europe any of those metals will have to pay the emission of that metal. Now, not 100%, it starts by 5%. By 2035, it reaches 100%. So if you take the case of aluminium, a polluting coal-fired power plant in China probably emits around 23 tons of CO2. They're going to have to pay, for every ton of CO2, they're going to have to pay the equivalent of 1 ton of EUTS, which is like almost 100, well, it's now 55 euros, but let's say the average of past years was 100 euros. So automatically, that high-emitting Chinese aluminium guy, 23 tons, 2,300 euros worth of emissions, you're going to have to pay when you import it, which is pretty much the price of aluminium. That guy is out. The one who's in is going to be the guy who's producing aluminium from hydropowered or recycled or nuclear. So that's how you're going to get whipped, if you want, into having, and we're going to get premiums. You're going to find a market of premiums for sure for aluminium, green aluminium, or cleaner aluminium, etc. And that premium will be relatively simple to calculate. It will be vis-a-vis just beneath the next highest emitter, which would be, let's say, natural gas for aluminium. So Europe is going to attract all that metal, that clean metal. How is it going to be able to attract that clean metal that's coming for aluminium, let's say, from hydro? It's going to have to pay a premium that's going to be just under the next emitter, which is going to be from natural gas. That's how I see the whole ESG, low carbon, or saving nickel, for instance, green nickel and straw coming in. Another thing, we already have like green aluminium. I think it trades at probably $9, I think, premium, which is not a very big premium. It's, I think, Trafigura and Concordia traded, if I'm not mistaken, but it's not a massive market. But I clearly see this market becoming a very big if you're dealing with Europe.
Just one other point. I think how I think this question about premiums and discussion about when is everyone going to pay more for something green? I'm not sure it's that way of thinking about it. I think it's discounts, not premiums. So it kind of equates to the same difference, same in dollar value. But I think it's going to become about companies making a choice not to source material from X, Y, Z. It's carbon taxation. It's ESG credentials. So I talk a lot internally about making sure we've got the data to support our supply chain, because if you haven't got it, maybe you can't sell it, and therefore you have to discount it to get rid of it. We see things like physical cobalt alloys in warehouses, and we see discounts on certain materials, not because of any sanctions, just because of a branding association with Russia, for instance. This is pre-Ukraine cobalt, but we sometimes see discounts on the same material, same spec, same everything, just because of its source. So I think you see these discounts in there. And I think there's great examples, across things like magnesium in the US versus Europe. I mean, essentially, you can't import Chinese magnesium into US because of tariffs. The price is just totally different. It's 100% premium in the US market. So suddenly, if you're producing in country, you've got a strategic advantage. You've got a premium for locally produced material, or a discount, if you like, for Chinese coal-fired, exporting energy type materials. So I think there's lots of examples where these kind of structural differences in pricing actually exist today. It's maybe not wrapped up in an ESG kind of framework yet, but I think that is coming. But my take on it is, if you don't know your provenance, you don't know your data embedded in your production, you will not in time be able to sell that material to certain end users because they will demand that. And then the other comment I have on it is, when I started out, I used to work in iron ore, and there was this whole value and use premium associated with putting high-grade iron ore into a blast furnace, right? And what you get out of that in terms of deleterious, or that's across different industries. But I often think about this value and use from a low-carbon input for an end user, especially in a regulated carbon system like in Europe, where if you put lower carbon intensity inputs, the end user essentially has lower carbon products. So there should be some kind of value share equation, which could lead to a premium equivalent, but it's those kind of things where I think there's opportunities for low carbon, positive ESG producers of these raw materials.
Just wanted to check with the audience to see if you have any final questions for our panelists before we start to wrap things up. Okay, so I thought it'd be good to kind of wrap up the session with just some, forward thoughts, biggest kind of potential opportunities that you guys are seeing, things that investors, juniors should be on the lookout for, looking forward to as kind of the energy transition continues to take gain pace and accelerate. So you can start at the end there.
Yeah, so maybe tying up on what I had said is, I don't think, there's a lot of disappointment with regards to, let's say, green nickel not finding the markets that was expected to be found. I think it's one of the issues they're facing is, I guess, they were first mover disadvantage, if you want. But from a European perspective, again, I think anyone who will have the lowest emission type of metal will be benefiting at some point from some sort of financial benefit. And given that mining projects, they're running for 20 years, might not be now that they're benefiting from it, but they will probably see the fruit of their investment in terms of low carbon, low emitting assets, probably by 2026, hopefully by then.
I would say that we're in a challenging market while the oversupply gets worked through on the inventory side. So we look at China today on the lithium side, we continue to see fairly good inventories, both on the supply side, i.e. lithium carbonate, but also in finished cell products. So there's quite a high inventory base in the manufacturing side, which needs to work through. So, the in-house sort of view of what it's worth is that that's a 6 to 12 month process from here on the lithium side, and probably similar on other battery metals. But I think when you see companies now pulling back to reality, we see major cuts in workforce, cost cutting, capex reductions. Again, biggest ones in lithium. There are others. There is now a natural reset, in the next 12 to 24 months for the next volatility cycle, mini cycle, if you like. And I think, as I said before, the overall trend is in the right direction, but playing those cycles is important. So there should be good value in established players and good projects coming through on the upstream side. And I think, just not the battery metal complex, but there are, as I said, other metals that are being well supported. I was asked about what's the best metal to play AI. And as the previous speaker was talking about, tins used in electronics. It's an interesting one that price is 31,000 today, and it was, last time I looked at it, in a blink of an eye, it was 24. So, antimony has gone up, 4,000 a ton in the last 3 months. So I think there are metals that are still in different cycles, and there are big opportunities there. And I think, if you're inevitably in mining, one has to be long-term and slightly contrarian. And I think this is a window to invest in a long-term trend in a smart way, whereas 2 years ago it was the wrong time, in hindsight.
Despite what you read in the media, then the energy transition is taking place, and it is demanding more and more raw materials like copper and battery materials, and that pull on demand is going to be strong in the future. Already, I think the trends we've seen this year are quite good. EV sales in the first quarter globally were up 22% year on year. If you look at the world's biggest market, China, January to April, NEV sales, retail sales are up 35% year on year. In April, the share of EVs was 45%. And in the first half of the month, it was over 50%. So it's rapidly growing in that, the biggest market in China. And in April, if you look at the battery demand in EVs, copper increased 46%, lithium increased 46% or 45%, and nickel was up 32% year on year. So these are really strong growth trends on top of what was a good year last year as well. So it continues to be a good environment for the mining sector, and as AngloAmerican, we're looking forward to working with junior miner space with what we're doing on the sourcing origination, and look forward to those interactions in the future.
I think my comments pretty much back up what Liam was saying, is to sort of have faith in the history of the cyclicality of, just because it's battery metals, they're still metals, and they go through the same cycles. And I still, I've been doing this for 20 years, and I still get frustrated that producers and developers still overestimate their ability to deliver, and analysts who are forecasting supply and therefore pricing listen to them for some reason, and don't look back at their own history and see that they were wrong, because they always are wrong. They are always wrong. I challenge anyone to find any period that producers have produced what they said they were going to do. And the demand in particularly battery metals has consistently, over the last, since I've been doing this 6 years now at TechMet, has consistently outperformed. So yes, we're in a cyclical low. Have a bit of faith. It will come back. And if we're in this situation now, you can easily imagine a situation where it's going to, certain metals are going to come back roaring. And is that actually a good thing? No, it's not a good thing for our portfolio. It's not a good thing for a lot of these things, because the heightened volatility makes it worse for financing. It makes it worse for investors. So I don't like it, but nevertheless, I think it's going to happen. Okay. Apart from tin's the only metal that I cover that the price is above my long-term price right now. But other than that, everything else is below.
Okay, well, it's a good place to kind of end things. I want to thank our panelists for taking the time today to kind of delve deep into all of these different issues. So thank you.